Consider Robert, a meticulous, retired structural engineer who mapped out his post-work finances down to the very last cent. Upon reaching age 62 last year, he followed a path chosen by millions of other citizens across the country by logging onto the official government portal to claim his Social Security benefits ahead of schedule. Had he chosen to exercise patience until reaching age 67, his full monthly payout would have totaled $2,500. By choosing to file early, however, he agreed to a permanent 30% reduction, which left him with a downsized monthly payout of $1,750. At the time, he assumed this choice was set in stone for the rest of his days. Yet within just a handful of months, local property taxes spiked, inflation climbed rapidly, and Robert came to the painful realization that he had committed a major financial blunder that threatened his standard of living. What he failed to realize, and what roughly 99% of older Americans remain completely unaware of, is that the system contains a built-in escape route. It is a completely lawful, fully sanctioned government mechanism for a second chance that allows an individual to wipe out the early filing penalty entirely and restore their checks to their absolute highest potential. If you are trying to figure out how to deploy this specific option before your personal clock runs out, it is critical to stay closely informed on these matters. The regulations governing Social Security, the critical cutoff dates for special provisions, and the exact methods for managing benefits undergo modifications every single year. When these adjustments occur, government representatives are not going to reach out to explain how to fix a devastating financial misstep or how to rescue your retirement strategy once you have already executed the official paperwork. Navigating those exact complexities is precisely what this breakdown is designed to do. To see exactly how a mistake like this gets corrected, it helps to examine the precise piece of paperwork Robert used to reverse his situation. This entire approach centers around a particular federal document known as Form SSA 521, which carries the official title of Request for Withdrawal of Application. You will never see advertisements for this form on your television screen, and you can rest assured that a government office worker will not volunteer information about it unless you explicitly request it by its exact name. To truly grasp why this specific document holds such immense leverage, you must first understand how the Social Security Administration views your choices surrounding retirement. When you choose to claim your benefits ahead of your full retirement age, you are effectively signing a binding agreement. The federal government agrees to start distributing your funds ahead of schedule, but in exchange, they apply a lifelong monthly reduction to your payments. For an individual in Robert's shoes, that 30% penalty does not just pinch his budget in the short term, it multiplies its negative impact over the long haul. Every single cost of living adjustment and every future inflation increase is computed using that smaller, reduced baseline figure. If Robert survives into his mid-80s, that lone choice made at age 62 could easily add up to more than $100,000 in forfeited lifetime wealth. Leaving that much money on the table simply due to a moment of anxiety or a slight mathematical oversight is an incredibly frightening prospect. Fortunately, Form SSA-521 completely alters the dynamic. Submitting this paperwork informs the federal government that you wish to rescind your prior choice, legally pulling back your original claim for benefits. Once the agency grants approval, they treat your entire earnings history as though you had never initiated a claim in the first place. The penalty you incurred for filing early is wiped away completely, freeing your monthly benefit amount to resume its upward growth by earning those vital delayed retirement credits at a rate of 8% per year until it hits its absolute peak at age 70. It serves as the ultimate financial reset mechanism. As is always the case when dealing with massive federal bureaucracies and sums reaching into the hundreds of thousands of dollars, this reset option comes with a very significant catch. You cannot simply decide on a whim to undo your retirement choice multiple years down the road whenever it happens to suit you. The Social Security Administration enforces 3 highly strict, unyielding guidelines to prevent individuals from taking unfair advantage of this policy. Pulling this off successfully requires navigating these boundaries flawlessly. The very first condition is the strict time frame, which is why acting with absolute urgency is so vital. You are granted a window of exactly 12 months from the precise date your benefits received initial approval to submit Form SSA-521. This serves as an inflexible cutoff point. It does not mean 12 months from the conclusion of the calendar year, nor does it mean 12 months from the moment you realize you made a miscalculation. It means exactly 1 full year from the date of your formal approval. If you happen to wake up on day 366 and realize your monthly distributions are insufficient, this specific pathway is permanently locked. This brief 12-month window exists precisely for individuals like Robert who rushed into an early claim out of anxiety or temporary financial duress, only to realize within their very first year of retirement that the math did not work in their favor. Perhaps they came into an inheritance, or maybe they chose to re-enter the workforce simply to combat boredom. They might have just sat down with a calculator and realized the early claiming penalty was actively sabotaging their long-term financial safety. No matter the underlying motivation, rapid action is mandatory. The second requirement is easily the most intimidating, and it represents the exact spot where the majority of retirees lose their nerve. While the federal government is perfectly willing to clear your record and reset your monthly payouts, they have no intention of letting you retain the funds they have already distributed to you. You are required to return every single cent you have collected and process akin to squeezing toothpaste back into its original tube. However, there is a subtle detail here that frequently blindsides even the most financially astute individuals. Your repayment obligation is not limited to the net cash that landed in your bank account. You are required to pay back the full gross amount. Looking back at Robert's situation, his gross monthly benefit across those 11 months was $1,750. However, the actual electronic deposit he received was noticeably lower because the government was pulling his Medicare Part B premiums right out of his monthly check. Assuming those specific premiums hovered around $175 each month, Robert was actually only seeing $1,575 enter his personal checking account. When he initiates his formal withdrawal application, he cannot simply write a check to cover the net funds he took home. He must issue a check for the entire gross sum, which means reimbursing the system for all of those deducted Medicare premiums, any voluntary federal income tax withholdings he elected to set up, and even any legal garnishments that might have been active. For Robert, multiplying 11 months by his gross benefit of $1,750 means he must produce a single lump sum payback of $19,250. Furthermore, this repayment policy extends well beyond your personal bank account. If any other members of your household are drawing monthly benefits that are tied directly to your specific work history, they are also required to return every penny they received. For instance, if Robert had a younger wife who was pulling a monthly spousal benefit based on his earnings during that identical 11-month stretch, Robert cannot reset his own benefits unless his wife signs off on the withdrawal in writing as well. Additionally, every single dollar she pulled as a spousal benefit must be paid back in full. If your household lacks the liquidity to return the gross sum plus the Medicare deductions, the tax withholdings, and any associated spousal benefits, the government will reject your petition, leaving you permanently locked into those downsized monthly checks for the rest of your life. The third regulation is straightforward but completely absolute, dictating that this is a strictly one-time privilege. You are allowed exactly one such do-over in your lifetime. If you complete the paperwork, surrender the massive repayment check, and successfully reset your baseline, you are entirely free to reapply for your Social Security benefits a few years later when you are older. However, if you happen to change your mind a second time, you are entirely out of luck, as the government completely forbids using the withdrawal strategy more than once. It functions strictly as a one-and-done emergency lever. So, what happens if you are reviewing this information and feeling a sense of dread because you initiated your benefits 3 years ago? Having missed that initial 12-month window, you are entirely barred from utilizing the withdrawal of application path. Does this mean you are completely helpless and forced to endure that permanent income reduction forever? This brings into play the primary alternative, a completely separate method that operates under an entirely different set of regulations. While it does not function quite like a chronological reset button, it serves as a highly effective tool to halt the financial damage and force your monthly checks to accumulate value. This alternative path is known as voluntary suspension. Voluntary suspension is tailored specifically for individuals who let the one-year do-over window slip away, but still desire to elevate their future monthly retirement income. The mechanism operates quite simply. Once you hit your official full retirement age, which lands at exactly 67 for anyone born in the year 1960 or later, you possess the absolute legal right to direct the Social Security Administration to temporarily halt the distribution of your monthly checks. You are essentially telling them to hit the pause button on your cash flow. One might wonder why anyone would voluntarily tell the government to stop sending them money. The answer lies in a powerful financial driver known as delayed retirement credits. For every individual month that you choose to suspend your benefits between the day you hit full retirement age and the day you turn 70, your underlying baseline benefit increases by 2/3%. This growth compounds to a guaranteed annual return of 8% on your money. Let us look at a different scenario for Robert to see how this plays out. Suppose he initiated his benefits at age 62, but did not recognize his error until he reached age 65. The 12-month window required for a complete application withdrawal is long gone, leaving him feeling completely trapped. He continues pocketing his downsized monthly checks of $1,750 for a few more years. However, the moment his 67th birthday arrives, marking his official full retirement age, he contacts the administration to demand a voluntary suspension. His monthly deposits halt immediately. Crucially, he is not required to return a single cent of the money he drew over the preceding 5 years, as those funds remain entirely his to keep. Instead, his benefit baseline sits on the shelf, frozen from distribution, but actively gathering value. He maintains this suspension for a span of 3 years until he hits age 70. Due to that 8% annual growth rate, his baseline benefit expands by a grand total of 24%. When he finally instructs the government to turn his checks back on at age 70, his monthly payment experiences a dramatic leap, climbing from $1,750 up to $2,170. He effectively generated an extra $420 in guaranteed monthly income for the remainder of his life simply by engaging the pause mechanism at the ideal moment. Just like the full withdrawal method, voluntary suspension involves its own set of strict complexities that require careful planning. The most vital element to consider is how this choice impacts your dependents. The moment you voluntarily suspend your personal retirement benefits, the federal government instantly freezes any secondary benefits that are currently being paid out to others based on your employment history. If your spouse relies on a monthly spousal benefit derived entirely from your career earnings, their checks will stop dead in their tracks during the exact same months that your own payments are paused. The lone carve-out to this rule applies strictly to divorced spouses. If you have an ex-spouse drawing a benefit against your record, your personal choice to enter a suspension will not disrupt their monthly income stream. For your immediate household, however, executing a voluntary suspension translates to an absolute freeze on that specific revenue source. You must possess absolute certainty that you have sufficient independent retirement savings, an employer pension, or part-time employment wages to bridge that income deficit during the years your checks are offline. Additionally, once you suspend your benefits, the government can no longer automatically withhold your Medicare Part B premiums directly from your monthly Social Security checks. Those premium obligations do not magically disappear. You simply become fully responsible for handling those payments directly out of your own pocket. Failing to establish an alternative direct payment schedule for those Medicare premiums while your Social Security is offline could result in an unexpected termination of your healthcare coverage, a catastrophic scenario that no senior should ever have to navigate. Both of these financial paths, whether it is executing a total withdrawal of application within that opening 12-month window, or triggering a voluntary suspension upon reaching full retirement age represent highly intricate financial maneuvers. They demand that you take a completely candid look at your personal life expectancy, your available liquid cash reserves, and your overarching tax liabilities. However, they highlight one undeniable reality regarding retirement navigation. The system is not an unbending black box that leaves you entirely powerless. While it is true that the governing rules are deeply bureaucratic and the costs of making an uneducated move are steep, the mechanisms required to alter your course are absolutely available. Whether you find yourself 11 months into early retirement and realizing you desperately need to strike the emergency reset switch, or you are closing in on your full retirement age and searching for a way to give your fixed monthly income a substantial permanent upgrade, the leverage is fundamentally in your hands. Success simply requires knowing which specific documents to file, which precise deadlines to honor, and the exact financial trade-offs of reversing your strategy. Ultimately, this centers around your money, your decades of professional dedication, and your personal future. Take the necessary time to carefully evaluate your own financial figures, and do not hesitate to consult with a fiduciary professional if your situation requires it. You should never fall into the trap of assuming that the very first choice you make is one you are forced to live with forever. If you or someone you know has been navigating these exact choices, share this information so they can see these options in time. Feel free to leave a comment below if this is a dilemma you have been actively weighing in your own household, as you are certainly not alone in trying to figure these rules out. Bringing these hidden choices to light can mean the difference between leaving money on the table and securing hundreds of dollars in extra monthly income for the long haul.